Hi, welcome everyone to our webinar series. This week, our topic is CEO's Insights, and we are going to look at analyzing global earnings calls at big data scale. Uh, I guess in India, we are still using a lot of earnings calls data, but we are taking that data. People are listening to data, listening to what CEOs have to say, and use that, and analysts use that data in analyzing companies. World over, there has been changes, and even there are some companies in India who do this. They take the earnings calls data and try to get the gist of it in a quantitative format from unstructured to structured. So, and that is being done by machines, by something called as natural language processing. Many of you are aware of this field, and this is going to increasingly influence everything we do, especially most parts of investment decision making. So for the speaker for today, we've been extremely grateful to Dan Joldzic for sharing his for willing to share his thoughts, his ideas on how he's running his company, Alexandria Technologies, and he's got a very detailed presentation to talk about the subject. Dan, he's the CEO, as you can see, of Alexandria Technology. And this company is a AI and NLP company that they analyze lots of financial text across news sources, earnings calls, company reports, and social media. Before the current job, Dan worked as a portfolio manager as a quantitative research analyst at AllianceBernstein, and he did a lot of factor analysis. So Dan is a frequent speaker on AI/ML topics. He's a CFA charter holder. He also has the FRM designation, and Dan has graduated from Penn State University with a BS in finance. So we've got, most of you will know that, we've got a 1-hour webinar with about 30 to 40 minutes of presentation time and an interactive 15-20 minute Q&A as well. We can stop, if we find something interesting, we can stop momentarily to check, the topic and take some questions. But don't wait for the questions till the 30th minute or the 40th minute. Put the questions on the Q&A chat box so that, we will have fun, we'll have more engaging time, and we'll try to get the best of Dan, his wisdom, his collective wisdom for so many years. I think Alexandria Technology has been there from 2008, so more than a decades of experience in natural language processing. So without further ado, let's give a warm welcome to Dan, and let's begin today's webinar. Over to you, Dan.
Yeah, thanks, Srinivas. Appreciate it. And it's interesting that you talk about the India market, because what we do find is there is a lot of coverage by India firms in the earnings call data set. It's, I was a bit surprised by it to see that the India market being, as developed as it is. I mean, I understand it's developed, but, that it has a really large number of calls on a quarterly basis. So you can get a lot of information on companies in a more timely manner overall. So we're Alexandria Technology, and we are a natural language processing firm that tries to analyze various textual documents. So our chief scientist is an early adopter of machine learning for unstructured data. The traditional norms used to be dictionaries back in 2008, 2009, but he was working with DNA, which was a bit more complex, right? You have sequences of ATCGs, and his lab was using machine learning to try to find relationships between the DNA sequence and genomic functionalities. So you couldn't really use dictionaries because of the variability. My background, as Srinivas has said, is in finance, so I thought we can use that in the financial domain as well. There's so much information out there that we can apply to financial text. So from the very beginning, we always used machine learning for the NLP pursuit. And that does mean no dictionaries. Now, when you're looking at machine learning systems, we're using supervised machine learning. That means you have to train it on a outcome. And the question we used to get is, why aren't you using prices? And we always used to think, well, we're living in a big data world. and prices are inherently noisy. The best resource for contextual understanding is a human or domain expert in the field. So we'd be better off learning from experts, and that's what we've done. All of our classification systems are trained by analysts. So these are people in the finance domain. They have experience in analyzing investments, and that becomes our ground truth or objective function. While we started in 2008, we launched our services in 2012. And at this point, we have classifiers for various document types. We have news, which is what we started with in 2012. We have earnings calls, which we'll cover today. We have social media, ESG, and we're going to be launching crypto in about 2 weeks overall. So, and that's just the start of this, right? Because we are living in a big data world. When we were thinking about starting Alexandria, there was this problem about big data. Right? There's so much information out there. How can you even come close to using it effectively for your investment processes, right? And in speaking to our co-founder, chief scientist, I used to kind of complain at AllianceBernstein. We had all of this information. We had Bloomberg News. We had Reuters knowledge management for sell-side research. We had internal buy-side research. We had our morning calls, which were recorded every day. Then there was a summary of morning calls that would be distributed to us later in the day as a reminder of what was covered. All of these textual assets that were underutilized. So I thought, this is a pretty good and rich textual place to apply NLP. There's so much information out there. We can see what could be valuable and what is not. So there tends to be 3 V's of big data. Now, if you look at IBM, they've added a 4th, and people are adding a 5th. But the traditional core was volume, right? There's been about 4.4 zettabytes. That grew to 35 zettabytes in 2020. A 695% growth. That continues to increase every single day. So there's just so much information out there. You need technologies to at least analyze the information to see if anything is valuable or not. Even if you find that something's not valuable, right? It becomes useful because we are resource constrained. So why pay attention to something that doesn't have a lot of value? Velocity becomes another V, right? In that all of this information comes at you continuously, right? It's now kind of born the idea of nowcasting, just grabbing information in real time and using it to update estimates. So, the news feeds that we probably get about 20,000 stories from Dow Jones. We work with other partners like Midnight Trader. There's just so much information out there. Overall, in the FactSet earnings call data set, which is what we'll look at today, it's 1.7 million documents, right? It's no single person or even team of people can go through that much information. And then there's variety, right? And this just doesn't apply to NLP. What we've shown here is, yes, there's news, there's social media, there's speech to text, there's images, right? But you're also dealing with, in the alternative data space, geolocation, satellite imagery, point of sales data, right? It's all of this information that's coming to light, which can really help investment firms improve their decision making overall. And as Srinivas said, please feel free to ask questions along the way. I'm happy to answer them while they're topical. There's no need to wait to the end. But this is kind of the core of, this is the problem we're trying to solve, right? How can you identify information from noise in a big data world?
So just one quick question, Dan. What was your biggest aha moment so far? I'm sure like your business is growing, as you had explained earlier. It has grown quite a bit from 2008 to now. But what were when you felt really rewarded? That you've done something for the community. Any quick quick example just to kind of make it interesting for the audience?
Yeah, well, there's been a few, but one of the bigger ones was probably around when we first launched our news services, right? I was a big skeptic. I wasn't quite sure there was valuable information in news, just because there's so much information that you get in your, like, this is 2008, right? Or 2009. Like, it's a Bloomberg terminal, it's a closed system. Like, how valuable can this stuff be? There's so much out there. that I feel like it's just noisy versus value adding. So, you spend all this, unfortunately, in the NLP world, you have to do all of this classification first to even know if you have something, right? So it's like we had to spend all this work classifying news to then say, okay, let's go back to my old role of back testing what we have. And I didn't think there was going to be a ton of value there. And then I was shocked to see how much value there was. And it was like, wow, like news is valuable, right? Like there is a ton of information in news that is clearly being overlooked because, well, at the time, the technologies weren't as prevalent to analyze them. And there's so much of it that people are probably just ignoring it, right? It's like, okay, I get a story about a company and 10 seconds later, I have another 100 stories, right? Like I just, that story gets buried in your mind, in your information capture services. So you just miss it. So that was shocking. The other funny one was Reddit. I read an article on CNBC in, it was March of 2020, right before, I guess, COVID happened, and it said, here's the chat room that hedge funds don't want you to know about. And it was talking about Wall Street bets. So I just messaged our programmer saying, hey, start listening, right? Start crawling this chat room. Like, I'm curious to see if it's something there, something we can add to our services or not. And she, after a week, I said, okay, now send me the data. I want to see what it looks like. Like, I want to see what the chat messages look like. And she sent it back, and I was like, oh, this is garbage. This is terrible. Like, you're dealing with people saying, like, I just made $10,000 on this option, or I'm going along this. I was like, this is not useful information at all. And so, we just move on. And then obviously fast forward to January 2021, and the Robinhood crowd and Wall Street bet community is taking on short sellers on Wall Street. And I messaged my the same programmer saying, are we still listening to that? Like, did you ever turn it off? And she said, no, I just left it on. I was like, let's revisit this. And I was dead wrong in March of 2020. Even before Reddit became as acclaimed as it is right now, there was significant alpha in 2020 when no one really knew what Reddit was about. Obviously, a few people did because of the CNBC post, but I was really surprised to see. I would have thought, well, 2020, it's probably flat, and then 2021, you get this move. But it was there in the early days, and I just simply dismissed it because it looked, quite frankly, it looked a little silly.
Right. No, that's a great insight. Let's revisit that again. I just wanted to, kind of make it more engaging. Let's go on because I know there's a lot to cover. But let's revisit that if that's okay, Dan.
Okay.
Thanks. Yeah. Sorry.
How do you mean, like, revisit? You want me to go into more detail or come back to that?
I had a related question. On you saw the data going back, and and then you said, wow, this is useful. So what made you think that? So ex post versus ex ante versus post facto. How do you how do quants how can quants make a case for the real investment decision maker, an analyst make a case to the portfolio manager that buy or sell? So we could take a look at that later, if that's okay, or feel free to do it right now.
Yeah, I can touch on it a little bit too, right? So obviously the trigger of going back and checking this out was to say, okay, well, January 2021 happened. You saw GameStop, AMC spike, and so it was like, well, let's go back and the great thing about these services now is, like, we have digital archives of everything, right? So once we started crawling Reddit in March of 2020, we had ongoing historical information from March of 2020 up until, at that point, February 2021. So we said, okay, like, run it through our classifiers, right? And then we're able to say, okay, everything has timestamp, not only the published time, but the received time by us. And we're kind of, for Reddit specifically, we have 5 crawlers at 3 different locations pulling every second. So the refresh rate is really high. And so he said, okay, well, we have a receive time. We can determine, at least on a daily basis, like when we do our back testing, we don't do anything intraday, but on a daily basis or even a weekly basis, like let's see, can this predict the next day ahead? Or can this predict the next week ahead? And so with just a quick run of our classification systems, you have at least an initial data set, right? Like a beta version, if you will. And we found that there was a lot of value. So then it's like, okay, now we need to do a few things on the NLP side, which is like train our classifier for emojis, because that didn't exist in news and that didn't really exist in earnings calls. So emojis were sort of ignored in the beta version. But as you train our system, now our classification systems for social read emojis. And so that only improved things from there. And you're able to, right, with the history that we have, quantitatively see if there is value or not.
Right. Okay. Thanks, John. Sorry for interrupting.
No, there's no. Please keep asking away.
Yes.
It's
And there's already a lot of questions, so yeah, let's move on. Thank you.
Yeah, and I mean, if you want to, if you see any questions that are relevant for the time, feel free to, ask.
Yeah. Sure.
Overall.
Sure. Thanks.
So, when it comes to NLP approaches, right, we've kind of covered some of this already. Like, how do you want to define the classification problem? Traditionally, it tend to be lexicon-based, which is just meaning dictionary-based, right? Overall, so you have a rule base to say, revenue up is a good word, revenue down is a bad word, earnings up is a good word, earnings down is a bad word or phrase, right? As mentioned, Alexander always used machine learning, and there can be supervised versus unsupervised, right? Like, I think it's still early days for unsupervised machine learning, because even if you try to find patterns unsupervised, right, someone still has to determine if that is a relevant relationship or not, right? So it's like, hey, a machine can say, I found this data cluster, but you're not going to probably just, especially when you're investing assets, you're not going to just believe the data cluster, right? Someone has to then look at it, like a researcher has to say, yeah, I think this is, this cluster can be defined as X or Y, right? Or this cluster is relevant or not, right? So we've always used supervised machine learning. And as mentioned, right, it tends to be trained by analysts, because that is, for us, our holy grail, right? Like, we want to think, if we build an AI analyst, you can apply that AI analyst to the massive amount of big data information out there and capture this information to see what is real or not. And so there are obviously pros and cons to both when it comes to machine learning or dictionaries. For machine learning, it is good for document level analysis, because you're not just keying in on single words or phrases, right? You're actually looking at the combination of words or phrases that exist within a sentence, within a paragraph, within an article. So you're able to produce classification. That's what recall is. Recall is, right, the ability to classify. And so you're able to really produce a high degree of classification. Recall ends up being a problem for dictionaries, because if you have very strict words or phrases, if you have any variability in the word or phrase, you then miss the concept altogether. So you sort of need to have, all of those variations in your dictionary, or those concepts are lost. All right. But, dictionaries do work if you have, like, what you would say tried and true kind of statements, right? Like revenue up versus, right? Like, maybe say that's an example, right? You're probably 99% of the time that is a positive statement, right? Unless it's like revenue up, but less than expectations. So machine learning can capture that relationship. Dictionaries probably cannot, unless, again, you have that entire 6-word phrase in your dictionary base. So we've always used machine learning for, again, the reason that you can, one, our chief scientist used it for kind of complexity in DNA sequences. But a big problem with machine learning is it can take a lot of annotation, right? Like, for us, it took 2 years just to get the initial training corpus to start our first classification systems. And now, that's something that we add to every year. And so we've had, at this point, probably over 500,000 labels from individual analysts, right, over kind of 10 years of operation. So, the models keep getting better and better with more training data. So today we're going to look at the FactSet earnings call data set, and it is a rich data set. It has 1.7 million corporate events in the history. You can see that the coverage is global, 8,000 companies in North America, 2,500 in Europe, 1,300 in Asia. And it mentioned India is actually very, very well covered within the data set. And so there are multiple types of calls. One is your classic earnings call after a company reports its financial statements. There are also conference presentations, guidance calls, sales and revenue calls, investor meetings, etc. So, it's not just the earnings event itself. So this kind of talks to even velocity. Even though this might be a slower data set, you still get calls that happen in between the quarterly update cycles. And we're going to use 3 different NLP techniques to analyze the calls. So first is going to be a dictionary. Right, so we kind of looked back and said, okay, here are differences and pros and cons of dictionaries versus machine learning. And we're using a very popular dictionary called Laffer McDonald. This was created by 2 professors at Notre Dame. And essentially, they built a rule base, which I call in this case a language model, or just have it highlighted under language model. They built a rule base by analyzing 10Ks and 10Qs. So they basically looked at 10Ks and 10Qs, the text part, and kind of extracted phrases manually. That would be positive, neutral, or negative. So things like revenue increasing or revenue decreasing, etc. So they ended up adding about 5,000 financial words. So it's not even 5,000 is not a huge number, right? But in looking at the various 10Ks and 10Qs, they added about 5,000 financial words. And because that is a low number, right, you would have very low recall, which we kind of discussed previously. They added it to a more generic sentiment dictionary of about 80,000 words. So 5,000 are very specific to finance. The other 80,000 are very generic, right? Things that would be kind of called good sentiment or bad sentiment. Now, Alexandria uses a machine learning ensemble. It's all supervised machine learning. Our language model, which again, a language model, I should have explained this, is what are the features or words and phrases we are using from sentences in the call, right? So here, we're not even using any type of classification. You're just looking at the words or phrases or the sentences themselves and saying, which words or phrases are repeatable for the most part. So we built our language model from earnings call sentences, since we're trying to analyze earnings calls. And our sentiment comes from financial analysts. So for earnings calls, it's about 200,000 plus sentences that have been hand labeled by GICS sector analysts, right? Because different analysts obviously cover different industries or different sectors. So, what someone might key in on for healthcare or biotech is going to be different from what someone might key in on for tech versus staples or utilities. And then finally, there's the famous BERT model by Google. Google BERT is trained on, it's a deep learning neural net, and it's trained on, the trillions of search terms and documents that Google has at their disposal. There were some academics that took BERT, which is generic, and wanted to train it for finance. So they took a public corpus for their language model, the Reuters TRC2 Financial Bank. So it's basically a bunch of news stories from Reuters. And then for sentiment, they used another corpus from LexisNexis that had about 4,800 sentences that were labeled by 16 people. So not only do you have 3 different types of techniques, dictionary, supervised machine learning, deep learning, you have the different language models, one from news, one from earnings calls, and then for the dictionary, it's just a rule base. There are also sort of different labels for sentiment as well. So we'll look to see how these things do, but let me at least show you how we're capturing this information, right? So obviously a call is probably about 5 pages, 6 pages long of text, right? So from the very beginning, we didn't want a single classification for the call, at least for sentiment and topics, right? So we said we're going to parse the call into multiple sections. and that can be based on sentences or paragraphs. So this is actually from a BP call. So section 39, you can see the statement, the refining environment remains extremely challenged and reflecting sharply reduced product demand. So this is the Alexandria classification. You'll see, okay, it's about product in the middle there, topic, ops/product, and it's negative, right? Reducing product demand. The next statement, like this is literally in a row, right? There's no gap in the middle there. We call section 40. It's turning to gas markets, weaker economy, reduced demand. So we say it's about gas, as you can see, commodity gas, and it's also negative. So for any given call, you have about 200 classifications or 200 different sections that we'll analyze. And that's important because it goes to, we applied the dictionary, Finbert, and Alexandria to each of these sections for the calls. So a call will have about 200 classifications for each type of NLP system, right? 200 for dictionary, 200 for Alexandria's machine learning ensemble, and 200 for Finbert. And we wanted to look at some of these differences. So now, obviously, I've picked, in fairness, I've picked some things where Alexandria is correct, but you have, let's see why they can be, law for McDonald or Finbert might be incorrect, right? So current turning to cloud, revenues are 4.6 billion, up 54%, growth was above cloud overall, significant growth. So all these are positive statements. So it's like, well, why is law for McDonald and Finbert actually classifying this as negative? And it's probably things like, you can see operating loss of 591 million. That might be another operating loss was 1.4 billion. So maybe that pushes the sentence into negative territory. The second thing is, turning to balance sheet, risk-weighted assets, RWAs increased. So that's actually good for a bank, right? So perhaps Finbert and certainly law for McDonald didn't have RWA in their language models. So that idea, that concept is missed. And then finally, non-GAAP operating expenses increased above the high end of our guidance range. And so this is where it becomes important on your kind of techniques, right? Because obviously you see above the high end of our guidance, which is probably considered positive, but you also see operating expenses increased. So standalone, you might have, okay, operating expenses is negative, above guidance is positive. And when I bring them together, they either cancel out or, maybe above guidance is a bit higher weighted than operating expenses. But what you want to do is join those sections together so you can understand that operating expenses increased, which is also tied to above guidance, which ultimately results in a negative classification overall. So these are obviously hand-picked examples, but when you look at the correlations of the classification, in the data set, there were 62 million classifications by each NLP technique. And you can see that the classification correlations are actually quite low, right? So of those 62 million, there's a lot of disagreement between Alexandria, law for McDonald, and Finbert, right? So 0.14 and 0.17 for Alexandria compared to the other two. And you also notice that Finbert and law for McDonald are actually a bit more highly correlated than you might expect, right? So 0.38. So law for McDonald and Finbert are closer than Alexandria was to either one, right? And that's also interesting because they're on opposite ends of the spectrum. Dictionaries are very rigid and easy to understand. And deep learning, one concern about deep learning or neural nets is you kind of the interpretability, right? You're not quite exactly sure what's happening under the surface, but the fact that you have kind of more complex and less complex are a bit higher together than your kind of more standard or traditional machine learning approaches. And then what we do is like we create net sentiment signals, right? So Alexandria, our core is to just analyze or classify these documents accurately, right? Like we don't send out signals, but obviously for a research purpose, we said, okay, let's create a monthly sentiment factor and let's see how the factors, right, correlate each month. And there, obviously, since they're all positively correlated, as you start aggregating up, you start increasing the correlations overall. So here now, Alexandria and law for McDonald are quite high, 0.45. and Finbert and Lawford McDonald are 0.41. Alexandria and Finbert is 0.30. So, decent correlations, but what you'll see is it actually leads to very different results overall. So we use the S&P 500 universe as our testing universe. The period that we looked at is January 2010 to September 2021 with a monthly rebalance. And so what we do is we create a sentiment score by just simply counting those positive statements. So from the prior example, right, it would have been 2 negative statements on the bottom denominator and 0 positive statements in the numerator. But in this case, we add an adjustment factor of +1. So it would be 1 divided by 2 plus 1. So 1 divided by 3 on a log scale, right? And we use a 6-month window for creating the score. So we actually look back 2 calls as opposed to 1 call. You could use the most recent calls. We actually found 6 months works a little bit better than 3 months. And intuitively, that sort of makes sense, right? 2 back-to-back positive calls does a bit better than 1 single standout call, right? So a company might blow out their current earnings, but it might just be an anomaly, where if you've had companies that have 2 back-to-back calls, it does a bit better overall. And we actually found that 6 months tends to be around the ideal. And then what we do is we have a score for the management discussion, because there's been some research to look at the management discussion and Q&A individually. So we said, okay, let's conform to that research. Let's build an MD score or sentiment. Let's build a QA sentiment. And then we'll just take the average of the 2 for a final call sentiment overall. And these are the results for the dictionary. So, a little over 100 stocks in each quintile, even though it's the S&P 500 universe, right? There's the annual reconstitution. So since we're holding things for about 6 months, we keep it in the portfolio until that 6-month period wears off. So, you get about 35 additional names that end up getting rolled off when the holding period is over. You will see that for Lawford McDonald, Q1, most positive. So we do the 1 to 5, where 1 is most positive and 5 is least positive or most negative. Some people flip that. Some people treat 5 as most positive and 1 is most negative. So it's in ascending order, where 1 is best and 5 is worst. And you'll see there is some alpha in Lawford McDonald for this particular universe. So 14% annualized return. It beats the S&P price-weighted index by about 2%. And for Q5 being the most negative, about 12%, underperforming the S&P by about 10 basis points. On a long-short framework, you have about 1.56% annually. That's an annual number. So there's some information there. I wouldn't necessarily call it strong information, but there's some information there overall. You can see the year-over-year performance as well. It's a few years of negative, but more positive than negative. So then we'll flip to the same exercise for Alexandria. Same universe, same time period, same rebalance, monthly, aggregation window 6 months, sentiment the same, and you'll actually see some different results, right? So average stocks are the same. Q1 is about 19%. It beats the S&P by 6.9%, 6.88%. And you'll see it's nice and sort of monotonic, right? Where Q5 has a 7% absolute return, right? But underperforms the S&P by about 5%. When you look at the annual breakdown on the bottom, only 1 negative year, right? 2016, there was a junk rally, but it's kind of interesting, right? When you're in Q2, Q3, Q4, there's not a lot of separation, but if you're in Q1 and Q5, kind of the tails, right, are where you get a lot of information overall. If you actually look at the standard deviation, you get a nice and monotonic results as well, where Q1 positive earners have 15% standard deviation. As you get down to negative earners, 17% overall. So there's obviously the alpha component of this, but there's a risk component as well that you can benefit from also. And then finally, there's Finbert. And, it's supposed to be the latest and greatest technology, but trained from the news corpus, it doesn't necessarily perform as well, right? So beats the S&P by 1.6% for Q1, so 14.59 versus 14% standard deviation. So the longs actually do a little bit better than the dictionary does. The sharp of 1.04 was better than the dictionary was 0.97, I believe. Alexandria's was 1.27. And the shorts underperform a little bit less. So for Finbert, it looks like there was more benefit on the long side than the short side. And you have these annual returns of 1% annualized, sharp of 0.6. And then if you look at, again, the annualized returns, there's a bit more negative overall. So, if you put these all together, I showed them individually. If you put them together, you can see the results here, right? So Lawford McDonald is your first column, and Alexandria is obviously your second, and Finbert is your third. And you can see that this is a cumulative P&L of the long short. Like, while you can use different NLP technologies and you can use different training data, right? Particularly more for Finbert versus Alexandria, right? Finbert used news sentiment. Alexandria uses earnings call sentiment. The results are very different, right? Alexandria P&L is much more than the Finbert and Lawford McDonald P&L. It's interesting that all three had negative results in 2016. Alexandria's was less, but you still had negative results in 2016. That was a junk rally, right? So that was a more macro type of event where people fled high quality names to low quality names. So while high quality names might have had better earnings, people didn't care. They chased low quality names overall. Alexandria outperforms the other two in all but 2 years. The early years for Lawford McDonald, 2010, 2011, seemed to do quite well. And then from there on, Alexandria, even in 2016, does a bit better. Interestingly, in 2021, Alexandria has roughly a 6.7% return, while the other two are negative. And Finbert is very negative, which is a bit surprising, given that you have this information as trained. It could very well be based on the time of the study too. I believe that Finbert paper came out in 2019 or 2020. So then that would make sense, right? As you walk forward out of sample, it really starts performing poorly. Now, I guess in defense to Finbert, one thing that Alexandria does is every year we add new training data to our classifiers, right? We want to see what's new and relevant information in the prior year. We only do it once per year. We do it at the end of the year. And then when we update our models, we don't backfill the history. We only apply the information going forward. So very much like a human would learn, right? Like every investment analyst will review and look at their investments and say what worked, what didn't work. Okay, like this worked, so I'm going to consider that in my analysis going forward. We're doing the same thing with machine learning, right? You take the most recent year, so in this case for 2022, take 2021 observations, add it to the model at the end of the year. Starting in 2022, you learned more, you have more information at your disposal, and you apply it going forward. So we very much mimic that kind of human learning in our systems as well. And so one reason why Finbert might not have done so well is because that model is static. It hasn't been updated. Lawford McDonald actually is updated, but it's a dictionary. So they add about 300 new rules every year. So it's not a lot, right? I mean, even our training data is not a lot necessarily relative to the whole, but it's more than just 300 words, right? So that could very well be in defense to the other NLP systems. It could be why they have negative performance for 2021, while Alexandria NLP does well overall. So, how can we think about this? That's part of what we kind of just discussed. And it comes back to the beginning. For dictionaries, they're very rigid. And even if you start adding words or phrases, you might have some conflict in the words or phrases that you add. And word ordering is ignored, like we just showed with but we showed earlier with a higher than guidance example, right? Operating costs increased, some space, higher than guidance or expected guidance. So machine learning can take those two concepts together where dictionaries do not, right? Each phrase is individualized. Finbert should have been able to pick this up, but I mean, in defense to Finbert, one, the language model is trained off of news. right? So it's not apples to apples. Like, news and earnings calls are different data sets. While we might reduce an earnings call to a smaller fragment, which might look more like news, it's still a different data set. So that is one potential weakness of Finbert, at least this version of Finbert. And then also too, the sentiment labels are very small, right? 4,800 labels is not a lot. Even if they were analyzed by 16, so times 16, it's still not a lot. So, you're going to miss a lot of information there. And so when it comes to Alexandria, you have this idea of, okay, well, is it the technology that, is it the NLP part of it, or is it the training data, right? Now, the interesting thing is we can help unify the training data question. So that's exactly what we did. We said, okay, it doesn't work for Law Firm McDonald, but because Law Firm McDonald is rule-based, but for Finbert, we can actually retrain Finbert with the 200,000 Alexandria labels, right? So we can just kind of rerun the Finbert training process. The language model remains the same, right? But the sentiment training, which is different, can be unified with Alexandria. So that's what we did. And I'll call it here FinAlex, all right? That takes Alexandria's 200,000 labels, runs it through the Finbert language model, and we get a new layer of sentiment, if you will. And what you find is the labels go a long way, right? Compare Finbert to FinAlex, and you've increased your return, your long-short return, from 1.34 to 4.86. You've reduced your standard deviation, and you've increased your Sharpe, right? You've taken your Sharpe from 0.16 to 0.66. Still comparing to Alexandria, it's 1.35, but you really can improve the model rather drastically. So, that would prove that labels, training labels, really matter, right? So if anyone thinks about building their own NLP systems, not all labels are created equal. There's a final question that remains now, right? Like, is it Alexandria's language model? Or is it, well, there's the final two questions that remain. Is it Alexandria's language model, right? The one that we built from earnings calls? Or is it kind of this NLP ensemble? Now, we can also take a step. I haven't done it yet because it takes a lot more compute power, but we can also retrain Finbert based on, or retrain BERT. At that point, it wouldn't be called Finbert anymore. We can retrain BERT based on earnings calls and build our own language model, and see how that does. And that could be another step. Based on those results, the final question would be, well, is it technology, like the NLP ensemble, like BERT versus Alexandria, right? And so those are things for further exploration on our side. Now, we've kind of covered the value of earnings calls themselves, but how do earnings calls compare to other data sources, right? Like, one of the new V's that people have added is value. What's the value of the data? That's a pretty important V. And this always comes to question as new data sets in the alternative data world come to light. And you'll see here, this is a paper by SocGen. They're actually someone we can name. They wrote a white paper based on our earnings call classification. And you'll see that the data period is somewhat similar. They did this from 2010 to June 2020. They published this paper in September 2020. That's why it doesn't walk forward to 2021. But they looked at Alexandria's individualized factors, one for the MD, one for the QA. And look, they did this themselves, right? Like, so the thing to say about Alexandria is we'll deliver out the kind of processed classification, but we don't want to send signals, right? So, we send these 200 classifications per call, and that goes out to end users, and then they can build their own signal off of that. So yeah, there might be slight tweaks to sentiment, different time periods. This actually looks at 3 months versus 6 months, which is one of the things I mentioned at the start. And you'll see that the earnings call sentiment has been the two strongest factors in the last 10 years. So it's outperformed growth, it's outperformed momentum, it's outperformed quality, profitability, and value. And they also looked at the residual above those common factors. And you can see two things. There's a healthy residual, right? The blue line at the top that continues to get larger and larger, right? So this is not something that has gone away, right? particularly in 2019 forward, right? Like the MD you can see has a nice sloping line. The QA was a little bit flat, but then picks up rather quickly towards the end there in 2020. So there has been a healthy residual over those factors. So you're picking up new information. It's not kind of information that exists in the traditional hard data. It is information that is new that you can use to add value to strategies. Now, the one kind of final thing to say is this is another paper published by SocGen. This one was in October 2021. They looked at adding earnings call sentiment to value and growth portfolios. And what they found was, it's explained from the residual value line chart previously, right? It's not correlated, so it should add value overall. But so it adds value to both growth and value. I just found value a little more interesting, right? Because obviously, well, maybe you don't know, but growth has outperformed value in the last 6, 7, 8 years, right? The return from value has been quite low in the last, well, it's been negative in the last 10 years. So value has underperformed, right? And when you add earnings call sentiment to value portfolios, you can differentiate between the value traps, right? The companies that just aren't going to get any better and continue to decline, putting them into deep value, and differentiate between those that might rebound. So you can actually take the black line is value standalone. You can take value and flip it with earnings call sentiment to positive, right? You're able to kind of get that improvement on value portfolios. So if you're a value manager and you're like, hey, I've been getting killed, well, earnings call sentiment might help you. Now, the other part is like when you do add earnings call sentiment to your portfolios, you don't change your value exposure. So, there could be this idea, well, I don't want to get more growthy. Well, you actually won't get more growthy. You'll actually remain virtually the same value loading. You're just ranking those stocks a little bit differently, right? And so, sentiment can really help value overall. And then finally, there's more to explore, right? Like we do not send out signals. Like we send out we summarize text that is difficult to manage. We structure it into nice tabular formats, and we deliver that out to end users. So one of the features that we have is topics or subject matter or events. I use those three synonymously. They all mean the same thing, just subject matter. And, there's always these questions of, do revenue beats do better than net income beats, due to cost? Well, you can actually measure that now. You can say, okay, well, when revenue is more positive than net income, let me weight revenue higher than cost subjects, right? So cost going down, fine, but I'm going to discount that to 80%, 70%, 60%, whatever you might want to do. And again, we don't tell people what that discount factor is. It's up to them research-wise to choose what they want to do there. Also, you can look at speakers. There has been some research on this, right? And I think the research basically said like CFO statements actually did a bit better than CEO statements overall. And then finally, there's different time horizons, and there's you can look back 3 months, 6 months. You can look back more recently, right? There's just a lot. It's a rich data set to explore. We intentionally try to just be a bit more shallow. We don't want to overbake things, right? Generally, what you find is if the information or data works on a shallow test, it will get better as you go deeper. Now, obviously, as you start adding more filters, there's always going to be a question of like, is this overanalyzed, right? The bad word of data mining. So, that's always something you have to be careful about overall. But yeah, this concludes our review of earnings call sentiment using different NLP techniques. I'm happy to answer any questions you might have.
Thank you, Dan. Thank you very much. There's a lot of questions. So we will save the questions that are related to the process, the few charts that you showed later on. we'll devote some time to that separately. But first off, just as some of the basics, and I can sense in the audience too, there are 2-3 types of people: those who are just getting to know NLP, those who are really hardcore quants, and many of the folks are in the middle. So I hope to make this to balance this out to everyone. So the first question being, it's from Vidhu as well as another anonymous attendee. What's your experience with Asian languages? And is this just for English? Has there been any work on, let's say, Japanese or Chinese, which have the same characters, or a Hindi and Devanagari is what we use in India?
Yeah. So we have worked on multiple languages, specifically Japanese extensively. And this was actually one of the core, this was another core argument that our chief scientists used in using machine learning in the very early days. You'd actually be surprised. When we first launched in 2012, people thought machine learning was bad. Like, we used to constantly go into meetings and they'd say like, oh, well, that's black box. Like, we don't know what's behind or what you're doing. We're gonna stick with a dictionary, or we're gonna think about using a dictionary. So like, we used to get like negative comments or feedback because we use machine learning overall. But I'm digressing. Our chief scientist would show us examples in native Chinese back in 2011, 2012, of using the benefits of using machine learning, right? Because at least in English, you have space is serves as a word boundary, right? When there is space, you know a word start and stops, right? Or stop and then starts. With character-based languages, it's not, right? A word can be 1 character, 2 characters, 3 characters, 4 characters. You don't know what it is. So machine learning and using conditional probabilities can help identify what is the, it's not perfect, of course, but proper character for a given word or concept, right? So in 2011, we actually did a project with the University of Kobe to analyze native Japanese. They were writing a paper on, does Nikkei leak news stories to big institutional managers before they're announced? And they had an archive back to 2010, I believe, and it's millions of stories. And they basically used us as a filtering service. They said, can you help us figure out which ones are good or bad? We said, well, we can. If you give us what you think is good and bad, we'll build a classifier, right, and we'll scan the full corpus and show you which ones are good or bad. And then they use that as a subset to say, okay, let's see if these were leaked or not. So machine learning does allow you to do character-based languages. We started in Japanese way back in 2011. We do work with Nikkei now. We have a Japanese language news service. Obviously Chinese is also quite interesting for us overall, and that's something we'll look at as well.
Right. So going to the next question, Gautam, and it also reflects in part, what I was asking you about the aha moment. So Gautam is asking, is there a time frame within which you expect an opportunity that the algorithm spots and it will materialize? And how do you, what weightage do you see investors giving to NLP or ML inputs that you get, given to them?
So the first question is related to what, dilution? Like, when will this finally be consumed by, or like fully arbed out?
What's
Is
the
that
time
right?
frame? Yeah. So he's saying, like, is there a time frame within which you expect an opportunity that the algorithm spots to materialize? So is it a week? I mean, earnings calls are typically, if I look at FAJ reports, I think they don't go beyond a few months, right?
So the funny thing is,
Right.
earnings calls last longer. Like, they go about 12 months.
Okay.
And quite frankly, I haven't even checked. I haven't gone beyond 12 months. Like, they could very well go to 15 or 18 months. I haven't looked. Like, it's just like at 12 months, you said, okay, we can stop. But there is alpha actually at 12 months. It really depends on the data set. News is a faster moving animal, right? Like that, the optimal time horizon is like a week or less for US, given the market efficiencies. In Europe, we've been told it's like 2 weeks. Asia is a bit longer, so the less efficient markets seem to have longer drift in information. But like, yeah, news is probably about a week or less in the US. And then social, even this, when we talk about your aha moments, like, again, I discounted Reddit because I was like, this can't last more than a day. And JP Morgan actually wrote a paper that found that there was actually alpha out a week. So, all these chat rooms and things, and I guess it sort of makes sense, right? Because the Reddit crowd has their meme stocks and their favorites. So they're talking about GameStop every day. So it only makes sense to last a week, but there is actually value out to a week. So it really does depend on the data set overall.
So how do you benchmark your output? I mean, how do you improve your service? Is there a feedback that you get from your clients? There's lots of questions, so feel free to just give a very short answer.
Yeah, I will. So I mean, the first thing is we measure accuracy based on analysts, right? So it's like we don't based on simulation. So for us, it's like which one has the most accuracy to an analyst? Done. Separately, we then test data to see if there's value. You'd be surprised. We've actually haven't worked with a few big names because we didn't find value in the data. It checked the first test of, hey, this is really accurate. Like we come to the same agreement, but it never materialized to value from a simulation standpoint. So we just don't add it to our data sets because we don't want to introduce more noise to users. The goal for us is to distill what's valuable versus noisy.
Mikhail asks a similar question as Gautam. He's saying he thanks you for the use cases, but he's saying there's lots of people in the financial services, investment decision making roles, and you've given a nice slide at the end. Who's using who are your customers? But what types of people are your customers? Asset managers versus those who are making allocations or buy and sell decisions. What type of people, or is it just research analysts? Because you mentioned you just give them research, right?
Yeah, I mean, there's multiple modes. So like, I'll walk through like the value progression, and again, I'll try to be fast. Like the first client base, and even the predominant client base, has been your quantitative hedge fund, right? Long short manager. They can be multi-asset because we're not just company news. Like we have macro news that we find works well for macro instruments. But your classic of like 5 days or less, right? Now with earnings calls, because there's significant drift, it's extended to pension funds because they're adding more and more quant managers to their internal PM teams as opposed to just kind of like allocating out to other firms. And I think you're going to actually see this progression where like those are the early adopters, but now you're sort of getting the quantamental users as well. So a lot of firms have like a risk or quant analytics firm. It's not directly tied to an investment decision-making process, but they're sending reports to the fundamental PMs. And then naturally it will move to, I think, your more traditional fundamental managers that can use this information from a screening perspective. Like, hey, there are 500 stocks in your sector, you're covering 10 of them, why not just have like a quantitative overlay or almost like, like a spotter? Why don't you have a spotter on the other 490 names to see if there's something you might like or not?
Right. So let's go now. We'll just extend it for 5 to 10 minutes, if that's okay with you, Dan.
Yeah, of course.
There's lots of questions. So with regard to the, the charts that you showed, and, you gave a comparison of 3 different, what the Logmorin model did, and, what Finbird did versus what Alexandria did. So how did you construct the portfolios, and, where Parul is asking if transaction costs were taken into account. Can you just give a very quick insight into how did you construct those quantile 1 to quantile 5 portfolios?
Yeah, it's all just a relative ranking, right? So, and it's the same for all 3, where, once you have this positive statements divided by negative statements, which is a very simple metric. But again, we do this intentionally. We don't want to overbake our analysis. It's just, hey, if there was 100 positive statements and 20 negative statements, it's 100 divided by 20. It's very simple, right? And so we do that for the MD and QA, and then just take the average of the 2, because we find that interesting. Instead of just having it for the entire call, like if the MD and QA diverge, that says something, right? Whatever the management prepared and whatever the analysts were asking were not aligned. So that would actually bring things more to the middle, right? And you can see it's pretty flat with the benchmark. Whereas if the QA and MD are in agreement, obviously that average is higher. And if the QA and MD for the positive side and on the negative side, they'll both point to the tails. And that's why I think your tails get kind of more of that big value impact overall. So, that's just a simple metric. It's done monthly, but obviously there's static data. And then we don't have transaction costs, but with a 6-month holding period, you're talking about like SocGen did this. It's like 25, 40 to 40% turnover year over year. It's very small. All three do not have transaction costs, so it's still apples to apples.
Right. Nimesh, he's asking a question, how do you adjust your models from year to year when there are big macro changes? Like, we talked about the COVID thing. There's a war right now. So how do you adjust your models?
The process is the same, right? Just because we don't want to be reactive to events, right? Like, the goal is to have this consistency. Well, no one knew COVID happened. Like, one thing we did was we added COVID as an event in March of 2020. Like, immediately we said, hey, this is going to be a big event for, everything shut down. So this is going to certainly impact the, either Q1 or more probably Q2 earnings calls, right? And so like we just need to start capturing COVID. So we added COVID as a topic and sentiment for COVID like immediately. That's the only time we've ever added training labels within a year. Otherwise, we wait at the end of the year for complete consistency overall. Now, the thing is, like, what we do is we're trying to look for new concepts in news, but that if you think of like a numerator being new training labels and the denominator being total training labels, every year that numerator gets smaller relative to the denominator, right? Like if it's like 20,000 every year, 20,000 divided by 200,000 is a lot less than when it was 20,000 divided by like 100,000, right? So the model remains pretty stable, and I consider that a good thing because it won't overcorrect in any given year. Like, and I think Finbert's the perfect example of that. Like that stopped training probably in 2019, and you'll see it just falls off in 2021, right? And that's probably because there was things that it didn't recognize. Well, given the small number of labels too, there were things that it did not recognize in 2021 that it could not classify, and that's why you get this negative performance.
Yeah, so I wanted to understand you've mentioned there are 200 classifiers, right? When you give your data to the analysts who consume it, what are those 200 classifiers?
So it's around 200,000, and it really depends on like the statements made by management, right? So you're right, it's 200 per call. Now it's through 10 years, it's been about 200,000 overall. You have to understand that 200,000 is it's less than 1% of the entire population of the earnings call data set, right? So our sample size is really, really small. Even though 200,000 is a lot of labels, it's small relative to the entire population. So we will essentially divide the call into 200 sections. And for the training process, the analyst will review the section, and we have this system. They can highlight text like this is positive because of this. Now, we don't use those hard-coded labels, like that hard-coded text, because again, it'd be too rigid. But what it does do is it points us to the exact sentence that they thought was relevant. So like you might have like, let's say 3 sentences in a paragraph, but the one they highlighted tells us it's this sentence that's driving the sentiment, right? So we take out that one sentence that might be considered positive. And so the 200,000 is essentially 200,000 sentences that have been extracted from calls, right? It's not like an analyst has to give us 200 labels per call. That's also a nice thing too. They're kind of picking and choosing what's relevant. So they're saying, hey, like I've looked at this call, this is relevant. Let me extract that. We get that information, and that feeds our training process overall.
Ashwin he's asked, like, can Finbird be used by any individual to train it to use earning calls? So it can be used. And if people want to, do it yourself and find out how to do things, what are the types of resources they can use on the internet?
Well, it's great. I mean, nowadays, right, there's just so much availability, right? When we first started, and I'll try to keep this short, right? Like we had we had to get offices with like a closet with a window, because like we had like this huge server rack that we'd throw in there with a portable air conditioner. Like we'd punch a hole through the wall if there was no window. And like that was our cooling, like that was our internal server room, right? Like now with the cloud, you can spin something up, you can get massive amounts of storage, and at like $50 a month if you wanted to test something out, right? And AWS gives you a free micro server to just start. So like that's easy. There are the open source libraries for Finbert standalone, like that's the pre-trained one that was done for academic purposes. You can access BERT standalone, and you can do it all yourself. That for Finbert, like that phrase bank, the Thomson Reuters News data set is a publicly available data set if you want to build a language model yourself. And even the labels, well, the labels are the harder part, but you can use Law Firm McDonald's free. You can go, it's on the Notre Dame website, like Law Firm McDonald, or just Google Law Firm McDonald dictionary. It's free to download. So you can really do these things yourself pretty easily. Python has a default sentiment NLTK, so you could take the earnings call text and run it through NLTK to see if that differs from Law Firm McDonald. Like the great thing about where we are technology-wise is it's the barriers to start are very low, but like we showed, right? Like it's Google's BERT, right? Like now in defense to Google's BERT, it was trained separately by some academics, but like you can have big differences based on training labels overall.
Just a quick this thing, for our charter holder community, what competencies, as I mentioned, there are probably three groups, people who are experts in and understood every single thing that you mentioned in your talk, then people in the middle who have just started to look at NLP, and those who are yet to begin. So for these last two groups, what do you advise? How should they begin to understand this fast-growing field of NLP? To make the question simpler, the analysts who are consuming what you're producing, what did they have to know to understand that they need to use NLP?
Yeah, I mean, like, so because it's big data, right? Like you have to consume this with a programming language, whether that is Python, which is almost like the de facto, right? But there's people that use R, and there's kind of a declining number of MATLAB users, right? Overall. So you'd have to have some understanding of programming language to start. At least that's historically what this was, right? Now you're getting different kinds of toolkits as well that would allow you to, like one thing that we do for fundamental managers, like let's say that is like, we can give you an Excel spreadsheet of, those counts by company. So every month you get, okay, here were the companies that were reported. And for the MD and the QA, there was 100 positive statements, 50 negative statements, and 30 neutral statements. And you can then start chopping up the data as well in Excel. And it's totally doable in Excel because it's 500. If you're using S&P 500, it's 500 companies per monthly frequency. It's only 6,000 data points per year. You can it's 10 years of 60,000 data points. Like it's totally manageable in Excel. So depending on like where you are, like if you're on the programming side, like you can build out the data set yourself if you want to. Back testing, like we give Python notebooks out when we work with anybody to just replicate if you want to at least understand, or it's actually more like proving that there were no errors in our data. And we've done this now hundreds of times to know there's not, but we hand over a Python notebook. So you could either build it yourself. If you don't want to build it yourself, you can just use Python to test it yourself. And the programming language part becomes like kind of the big differentiator. If not, like I said, there are ease of use tools for testing as well.
If there are two books that people should not miss at all on NLP, which are those?
That's a very good question. Yeah, I don't, it's funny, like I haven't done a lot of published book reading in NLP. I have to say, quite honestly, like more lately, it's reading white papers. So like the Finbert, there's actually two forms of Finbert too. There's like Finbert white papers, there's BERT white papers, there's a ton of white papers on different NLP approaches. So yeah, I'm sorry, I can't give a book, but there are some great white papers out there that I don't know, I feel can get you where you need to be pretty quickly to understand like a particular type of data set.
Thank you very much. I think we have already overshooted the time. The session was very informative, Dan. Thanks all for attending this session. I hope you found this to be useful. Please stay well, stay safe. Thank you again. See you soon.
Yeah, thank
Our
you.
next webinar. Thanks a lot, Dan. Our next webinar is on the 7th of April. Talk to you soon. Great. Thanks again, Dan. Bye.
Thank you. Bye.